our sort of position in terms of our equity exposure is not, it's not actually, I sound like an uber bear, and we're not underweight, we're actually pretty much flat equities. We've had bigger sectoral positions in favour of the value cyclicals and out of the expensive US growth sectors, and we've been overweight commodities. And I think the bigger message at the moment is maybe those commodity overweights come down and we start to move back towards bonds and the bond-sensitive defensive sectors. There's not a time for leverage, because if you look at the last central bank-inspired bear markets, I don't mean the sort of economic flash crash that happened with the COVID lockdowns. If you look back to 07, 8, 9, or 2001, 2, 3, or the early 1990s, you had 2 or 3 year bear markets in stocks, and we've had 6 months so far. So earnings are the next problem. Central banks do need to squeeze inflation down, and that means creating spare capacity. And this could be quite a long grinding period. And people always say to you that, you know, with bear markets, there are many, many opportunities to lose money. And all the biggest up days are in bear markets. So don't get too sucked back into markets, I would say. This rally could persist a bit longer, but don't think this is the end of the bear market. I think there's quite a bit more time to run through. And you've got to be tactical and you've got to be diversified.
Trevor, very good morning to you from Schloss Elmau as well. When I look at what policymakers are doing and their appetite for markets to have severe declines, for the appetite for bear markets, I don't see much appetite from central bankers anymore. In fact, I see them desperate to perhaps stop any quantitative tightening and actually start quantitative easing yet again, if indeed they need to. Do you think actually that's a risk to your bear market scenario? And I appreciate everything you were saying about historical patterns of bear markets in relation to unemployment. The appetite of authorities to allow a bear market as well, would they potentially pump up assets to a higher level than they probably should be, regardless of those earnings concerns that you have?
I don't pick up the same signals at all. I mean, when I read statements from central bankers, they are not the investor's friend at the moment. They're much more concerned about inflation and inflation expectations than they are about what the level of the stock market is, or even the level of the bond market. So, you know, there are times, you know, we've been conditioned, if you like, since 1980. Those of us who've been in the markets quite a long time, to think of central banks as cutting rates at the drop of a hat, because we've been in a disinflationary world. But now we've got the move to net zero, the lack of commodity investment, the deglobalization, Brexit, massive public infrastructure programs. You've got a lot of things going on at the moment that are more like the 70s, the pre-80, more inflationary period. And their central bankers will raise rates early and cut rates late. And I think when rates do reach their high, I think they could just stay high for quite some time until the economies have created enough slack. So I don't think central banks would ease policy at the drop of a hat. Major market crash, like 1987, they probably would. But remember in 1987, when Greenspan cut interest rates after the crash, it was only a brief pause, and then he was hiking rates again into 1989.